John Angrist, how is your Cognios market-neutral large-cap fund different from the other alternative funds on the market?
Well, in a couple ways. Ours is, the fact that it's market neutral makes it a special case of long-short equity. So our long book is about equal to the size of our short book, which means we try to hedge out all of the risk of the market. The second fact that makes it different is that we use a beta-adjusted approach, so that not only is the large book and the long book and the short book about the same size, but we actually adjust the size of the short book based on the relative betas so that we do hedge out the beta that we say we're trying to hedge out. In our case, it's the S&P 500. So our long book and our short book are all constituents of the S&P 500. The third point that makes it different is that we target equity-like returns in our market-neutral product. Most other market-neutral products are targeting risk-free rates, and we think we're one of the only funds that does that. So if we're taking all the risks of being in a market-neutral product, we're still trying to deliver attractive returns.
Do you feel like you're stretching for risk if you're seeking equity-like returns?
Well, we don't. Actually, the volatility in our fund is not that dissimilar from other market-neutral and long-short equity funds. We think we're trying to generate higher returns, and we've been able to generate higher returns by doing that. And it's why we're in the top of the category.
Can you talk a little bit about the volatility in the market? We saw the VIX, or the so-called fear index, over 20 back in January and early February. Now it's back below 15, and it's really stabilized. Where do you see it going from here?
Yeah, well, we're no good at forecasting the VIX, and we're not any better than anybody else is. But the VIX is low, and when the VIX tends to spike, it tends to do that when the market's going down in the more recent period of time. And market-neutral funds tend to do better than the index when the market's going down. The reason is we have shorts. So when the market's going up, our long book is making money, and our short book is losing money. When the market's going down, our long book tends to lose money, and the short book tends to make money. So we tend to do a little worse than the market when the market's going down, but tend to do better when the market's, we tend to do a little bit worse than the market when the market's going up, and a little better than the market when the market's going down. So a rise in the VIX is typically a pretty good sign for our fund.
Can you talk about how you choose the shorts and the longs in your portfolio? Just dig a little bit deeper into what's in your fund.
Sure. The basic stock investment portfolio philosophy that we use is called ROTA Rome. ROTA stands for Return on Tangible Assets, and that tells us how good a business is. Businesses with high ROTA are better businesses. They're the ones you want to own. ROME, which is Return on Market Equity, it's basically cash flow yield on a stock, tells you whether or not that stock is cheap or expensive. So our long book is generally comprised of companies that have high ROTA and high ROME. Businesses you want to own at prices you'd be happy to pay. And the short book is nearly the opposite. It's companies that we don't think are very good businesses with low ROTA and or are just trading at very high prices and very poor valuations.
And where should your fund fit into an investor's portfolio? How much of the Cognios fund should people buy?
Well, in the past, alternatives have been somewhere between, in somebody's portfolio, 0 and 20%, let's say. And our portfolio would fit into somebody's alternative portfolio within that allocation. But as investors get more and more scared of equity valuations and get more and more dissatisfied bond yields they're getting, we think the entire alternative class, and our market neutral fund in particular, has the potential to take some of the allocation away from traditional equities and traditional bond funds.
And then finally, should investors be worried about equity valuations right now and bond yields?
Well, equity valuations are certainly much higher today than they were 5-6 years ago and even a year or two ago. Bond valuations, of course, are near the highest they've ever been. So we think it's right to be worried about equity market valuations, but more importantly, bond valuations. Equities are a little above average, but bonds are nearly the highest they've ever been. So what we're seeing is more people taking allocations to their bond portfolio and putting into alternatives, and specifically market neutral equity. So market neutral equity, actually, even though it's an equity structure, is starting to replace bond allocations. Over time, as the market starts pricing in rises in interest rates, we think we'll start seeing increases in allocations away from traditional stock portfolios into the market neutral structure as well.
Thanks a lot, John.
Thank you. Appreciate it.